good afternoon, and thank you for joining another edition of the Kansas City Commercial Real Estate Market Pulse special edition. This is our eighth edition of the Market Pulse, but special edition here today as we've got Blaze Tomazik here with us, and very excited to introduce him here in 1 second. Blaze, how are you doing today?
I'm doing well. I'm a Guardians fan, so I could be doing a little bit better if they could beat the Yankees today, but we'll see how it goes. I know the Royals
Yeah,
had their own problems with them, so
that
hopefully
team
Kansas
is
City's
a
behind me.
that is a good team, and we would definitely like to see the Guardians take a couple games here. So, when's the next one?
I think it's today, sometime late afternoon, maybe like 4 or 5 o'clock. So kind of
Okay,
an interesting time. But New York normally gets those postseason, primetime slots, but I guess LA and the other New York team get it tonight. So.
well, awesome. Thanks first and foremost for being here today. I know that you were just here in Kansas City giving a very similar presentation to a group of real estate agents and brokers here locally. Got back home, and now we're doing it again. So we're definitely going to have an enlightening conversation here today. Just a few housekeeping items. If you have questions, make sure to drop them down in the chat. We'll be monitoring that chat, and we will have a time for some questions so we can get to those here at the end. So what are we doing here today? Well, I mean, we're doing this every single other week, right? We're here showing up as the Exchange Commercial Real Estate and doing the Kansas City Commercial Real Estate Market Pulse, which is, just giving the market up-to-date information on commercial real estate here in Kansas City. We're talking about a lot of different current listings, market trends, transaction overviews, and our most favored content and most viewed content is when we have guests on like Blaze here today. So we're going to continue to do this. We also have lined up some incredible guest speakers to come on here in the near future. There's our team. Katie Cobb is all things commercial real estate for Exchange, and Micah and Max on the multifamily side. Nick is in the capital investments and market side of the land development. Chad's on the medical and healthcare side, and Nathan does a little bit of everything in regards to multi-tenant retail, flex, industrial here in Kansas City. So if you are interested in understanding your current value of your property, or you're looking to make a new acquisition or have a 1031 exchange, please reach out to us. It's our job to go help facilitate those conversations. Without further ado, I'd like to introduce you to Blaze. Blaze is just a wealth of knowledge. Every time he's got a new article that comes out on CoStar, I'm always sending it over to Katie saying, hey, you need to check this out. We need to look at this. We need to get it to our team. But Blaze, you've been doing this for a while now, man. So why don't you just give us a little bit of your background? Because I love that you were the vice president of office brokerage at JLL. I think that's fantastic. So you're going to have a really unique perspective on things. But give us a little bit of background and how you ended up at CoStar.
Yeah, so I started in commercial real estate in January of 2008, which sure as anyone and everyone knows here at this point was an interesting time to start. I started off as an analyst with JLL and our St. Louis office here. Was there until about early 2021. Went into the home building industry a little bit, and then ended up here at CoStar about 2 years ago. But when I was at JLL, kind of ran the gamut. I ran our research for St. Louis, helped train folks in some other markets, but just kind of became the knowledge expert for all things commercial real estate for that group. Did a lot of financial analysis, a lot of new business presentation, things like that, and just kind of talk to the market. And it was my job just to know what was going on, all things CRE. I've got a background in finance, so that's helps with all the numbers and stuff that I deal with, and really kind of hit my stride here the last couple of years at CoStar, just covering industrial, retail, multifamily, and the office markets for not only St. Louis, which is where I sit, but also Kansas City. But yeah, ended up in St. Louis because my wife's from here. We met at the University of Dayton. I'm originally from Cleveland, but she's from here. She moved back here. I followed, and now I've got a 9-year-old son and an 11-year-old daughter here.
That's awesome. Thank you for sharing that. Now, one question I didn't really have teed up, but did come to my mind, and I did prep you that I'm going to do this, off the cuff a little bit. However, when you think about Missouri, right? We've got Kansas City, we got St. Louis, we got Springfield, we've got some other markets, but what are some differences and similarities? I mean, obviously are looking at commercial real estate and looking at the analytics and numbers around those two markets. But man, I'm always curious because when I talk to investors or property owners and they're pretty agnostic, or sorry, they're pretty specific, not agnostic, to going to one or the other market. So do you have
Right.
any just like off the cuff, insights in regards to similarities or differences between the two? Because I think that would be interesting.
Yeah, it's interesting. They're both border towns, obviously. So in St. Louis, we've got Illinois.
Yep.
In Kansas City, you've got Kansas and Missouri. But it's interesting. Majority of our population in St. Louis is on the Missouri side, where over in Kansas City, you're seeing more growth in Johnson County and
Yeah.
West, obviously. But obviously, population growth is, I think, a stronger trend for Kansas City right now. You've got a little bit more industrial development. St. Louis has been a little bit more conservative on that front, which is not necessarily a bad thing, considering we're seeing a little bit of a slowdown in
Sure.
leasing relative to what it was a couple of years ago when things are really coming out of the pandemic and going really strong. But as kind of barbell markets, I think with St. Louis, a lot of the development just continues to go west because that
Yeah.
river is a little bit of a dividing line, and it's not as balanced of a market. Your center is kind of moving further west, whereas Kansas City seems to be a little more centric because you don't have that buffer of a river that you've got to go across bridges to get to. It's amazing when I'm in Kansas City how quickly I cross state lines and don't even realize it, as in going back and forth.
Absolutely.
Yeah, and it's just Kansas City's downtown seems to be doing a little bit better right now, just based on my feedback and what I've experienced being there. The last couple times I've been there, I feel like there's been a little stronger development front, especially with the streetcar system
Yeah.
that's being that was initially put in a couple years ago and now is being expanded to the north and the south. And for what I'm gathering and understanding, there's a lot of new development happening along that line because you've got that permanent mode of transportation now, and it kind of running from the plaza all the way up to the riverfront. I think is going to be a huge win for that downtown area, just kind of going through all that. Um, and then obviously with whatever, the sports teams are doing in Kansas City, I know there's some issues, potential changes of stadiums with the Royals potentially going downtown, which could be another boom for development. I watched it happen in Cleveland when they built, at the time in the mid 90s was Jacobs Field.
Yeah.
And that you kind of activate an area around there because all of a sudden you've got activity going on 81 days a year. Whereas there may have been not as much, going on prior to that. So, I know obviously Kansas City is a little bit smaller on the population front, but I think as population growth goes, it seemed to be doing a little bit better job on that front. And the multifamily market has shown that as well. There's been a little bit more development, and demand has been strong in both markets here over the last couple quarters, really since the start of 24. But again, like the industrial market, Kansas City seeing a little bit more demand and a little bit more development. So it just kind of doing a little bit better, in all facets here.
Yeah.
Not that St. Louis is doing, very poorly in anything. It's just Kansas City's kind of just a little bit of step ahead right now.
Well, as a Jefferson City native, I grew up going east to St. Louis and west to Kansas City, so I was able to visit both towns and cities on a regular basis. Obviously, residing here in Kansas City, and you mentioned the streetcar. Our office building is plotted right next to the streetcar expansion, and I have been the beneficiary of all of that construction over the last year and a half or two
It
years. So
seems
that's
like a
been
lot. I've seen it in action myself, so I get it.
Yeah, but we're very excited about that getting completed and that continuing to transform Main Street here in Midtown, all the way down to Brookside, the Plaza, all of that. So very exciting stuff. One thing I study quite a bit is public infrastructure, and that being extremely important to real estate. And I've actually seen a number of institutional style of funds or real estate investors kind of generating or creating what they're calling a new asset class, which is infrastructure. So that would be a very interesting thing for, and I'm sure CoStar's already working on this, but like thinking about, okay, is that some sort of an asset class that you can actually start to quantify and people are going to be investing in and around? Very interesting development. Don't need to go into that right now, but I'm highly interested in the infrastructure because as you see those things being built, like you mentioned, all the real estate around that just drives all of that traffic, and that's where opportunity can come. So when I'm talking to investors, a lot of times they're like, well, where should we focus at? Well, let's talk about where the public infrastructure is started, and then we'll span out from there, right? I mean, I think
Yeah.
that's a really important component. And big cities, in cities that are trying to grow, to do it the right way, you have to invest in infrastructure. And that is one thing I've seen Kansas City continue to do. We still have a long way to go, let me tell you that. But I don't think there's a sizable market like Kansas City, or very similar to Kansas City, that you can drive 40 miles in 40 minutes. I mean, we have so many highways here, and more highway, I think, in this city than most do in the United States. And that is a very accessible way to get around. Now, obviously, you hit traffic, a little bit of what we call Kansas City traffic, right? Not a whole
Right.
lot,
We
but
have that too. Yeah.
it's incredible, right? I mean, I was in Kansas City, Kansas today. I was down in South Johnson County today, and I'm just driving all around. And one thing I do appreciate is the 435 loop and being able to get from point A to point B, and the city continuing to try to invest in making that easier and accessible for people. And I think that's a marker that investors need to keep their eyes on.
Yeah, and something that's probably going to eventually benefit both markets is when I-70 gets expanded to 3 lanes both directions. That
Yes,
should be helpful. Having done that drive enough over the last couple of years, especially with the amount of truck traffic that's traveling east and west there, it'll be very helpful. And I think it should open up a lot of those, or at least decrease some travel time to make things flow a little bit smoother.
most definitely. Well, Blaze, you were here in Kansas City giving this presentation, the state of the market, yesterday, I believe, here in Kansas City, or the day before. So why don't you tell us a little bit about what we're going to be talking about today? Let me pull up our agenda.
Yeah, so just kind of a quick, high level overview. Most of my slides here are tailored just to the local market. I can kind of touch on some national trends as well as I'm going through this, but we'll start with just kind of an economic update, which we'll just talk about what's going on in the labor market here, and kind of touch on a couple industries, and then we'll kind of hit on the four major food groups here, and maybe do some Q&A on capital markets. But we'll start with the office sector, and then dive into retail, which kind of funnels into the industrial market, and then finish up with the multifamily or apartment market, as we're going through this. So just kind of some
Fantastic.
high level charts, graphs, and just kind of some data points here to talk through those industries.
Yeah, looking forward to it. And again, anything that we're covering, please drop a comment down. We'll be monitoring that, and we'll get to it at the end. So thank you for that.
Yeah, so let's get started. So obviously, let's start with the labor market, because jobs lead to spending and growth and all sorts of other ancillary benefits. Um, so as you can see here, obviously, like most parts of the country, there was a huge drop off in jobs during the pandemic. Obviously, early 2020 was a really difficult time for a lot of folks, but the market's come roaring back. There's been a significant uptick in the number of people employed in Kansas City, especially as the market's been growing with its population. The unemployment rate is not as low as it was, and that's it's not because the market is shedding jobs or anything, but as the labor markets tightened up, and you had unemployment hovering around 3% for well over a year,
Right.
it brought some folks back to the labor market. And as you've had population increase, that's also increased. So as your labor force is increasing a little bit faster than your job growth right now, the unemployment rate's ticked up a little bit. But as you can see, we're still well below long-term trends here over the past 25 years.
Yeah, I have been just astounded by the labor market in the United States and the resiliency. And Dr. Peter Lindemann is an economist that I very much appreciate, and he always says to not bet against the United States, and there's a reason for that. But it's been phenomenal to watch this just impact people's lives, and the way that it was able to bounce back. Now, there's a lot of reasons for that, but very exciting to see on this front.
Yeah. So this is the job growth on an annualized basis, so year over year change. So as you can see, I'm not sure, that might look a little wonky on the page there, but those blue lines are the year over year changes in jobs here, and in non-farm payrolls in Kansas City. But obviously, the pandemic hits. There's a huge loss in jobs, and we kind of snap back starting in 2021, and kind of steady growth, call it 2.5%, give or take, for a couple of years there. And it's slowed a little bit, but again, when we were at 3% unemployment, it's hard to keep adding jobs at a clip that you were when you're at that low of a level, and there's only so much slack in the labor force. So again, still maintaining a decent pace, but not what it was coming out of the the post pandemic era, call it.
Absolutely.
And then this is just a breakdown by jobs, by job growth by industry. So this gets updated every month as the BLS comes out with new data. But as you can see, kind of leading the way here on the left side, manufacturing is up, and that kind of fluctuates, every couple months here. But leisure and hospitality is the second fastest growing industry or sector, and that's been that way in Kansas City for a while, and many other parts of the country. We've had a lot of consumer spending that has been increasing as the world opened back up the last couple of years. Hotels are restaffing. Retail is super tight right now with availabilities at record lows. So there's been a lot of hiring in that industry. And then you've got the eds and meds next with education and health services. And then so from there, you go to the right side where we're looking, at kind of a slowdown in job growth. And that's, primarily not all, the three primary office sectors are financial activities, professional and business services, and then information. As you can see on the right there, the two that they're lagging right now are the information and professional and business services sectors. So something to keep an eye on as we've had, kind of slow office demand as obviously folks are changing their utilization of how they are taking office space and how much space they're using and what their work from home or remote situation is for their employees. So kind of something to keep an eye on here, and I've actually got that in the next slide. This is just the general uh, you know this is indexed to January of 2020 for the three primary office sectors I was just talking about. So as you can see, financial activities and professional and business services are actually down from where they were in 2020. Um, Obviously, information kind of ratcheted up, but
Yeah.
these industries had a pretty good run of hiring back in 22 and 23, but have kind of slowed down a little bit. So again, something to keep an eye on for the office market, which is already showing going through a kind of a tough time now with demand just because of the way folks are using office space still.
Yeah. One thing that I noticed on this chart here was the manufacturing, obviously being the largest. You said this is month over month or year over year. I can't remember, but
Yeah, year over year. Yep.
yeah, year over year. I mean, I think that we experience this a lot when talking with people. When something happens like a global supply chain issue, like a COVID-19 pandemic, I think a lot of businesses were at risk, not being able to continue, their production and their manufacturing because it was overseas or was somewhere else. And I've been watching the onshoring of manufacturing in the United States, and
Yep.
obviously that being really great for industry and really great for jobs and things like that. But one thing that people don't really think about is globalization. So if we're taking those jobs and bringing that manufacturing back, stateside, things are going to be a little bit more expensive because that's just, I mean, that's just the way that is, right? And
Yep.
that's economics 101 right there. But I think there's been a lot, and I can't remember the exact stat, but I think it was like 1,800 companies had moved their manufacturing from overseas back onshore in 2023, which was a huge number. So that's having a big impact on obviously industrial real estate that I'm sure we're going to talk about, but the manufacturing sector here in the United States. So one thing that I obviously very much enjoy is seeing that for not just for the commercial real estate, but for United States companies as well.
Yep. Absolutely.
All right, let's go into one of the most debated hot topics in commercial real estate right now, Blaze, which is the office market.
Yeah. This is just kind of a historical perspective here of what has shifted here in the office market. So as you can see, I've got a couple lines on this. This is trailing 12-month absorption, which if you
Okay.
don't know what that is, it's the difference between move-ins and moves-outs, right? If it's positive, things are growing and there is less space available. If it's declining, there is more space getting put back on the market. So as you can see, pre 2020, the Kansas City office market was doing pretty well. You had on an average at any given time from 2016 to 2019, number was about 1.5 million square feet. But as the world changed post pandemic, we had that shift down. So over the last couple of years, and from 2020 to 2022, we saw a shift in office usage and a lot of companies giving back space and not needing as much. So that's kind of averaged about 1 million square feet to the negative in that run. But at least at this point in time, it looks like we're kind of getting past the worst of it. You're not seeing as many large, availabilities come on the market now. That it's still happening, but just not as frequently as it was. Call it, mid 20 to 22. So we could be getting past the worst here, but obviously, as I was mentioning earlier, with slowing office employment, there could be a little bit of a challenge there coming ahead. But yeah, definitely a big shift in this market here. Probably bigger than any of the other three,
Yeah.
just based on what you know how we changed our utilization.
Yeah, and I would say too is like when we're thinking about office, I mean, um, I'm not convinced that office utilization doesn't continue to increase. I mean, who was it? It was Amazon. Maybe it was
Yep.
another large company that is saying we have to get back to the office. I know, for example, my wife was definitely work from home 24/7. For 2 years straight, and they are required to come back to the office for I think it's 24 hours a week. Tuesday, Wednesday, Thursday. She drives up to her office building now. She's there right now. And I think that's going to be a continued trend going forward. And I've seen a lot of people try to politicize this issue, and I don't think that's it at all. I mean, Peter Linneman talks about this a lot. It's like, how can you manage effectively? I get it. There are certain aspects of job that you can work remotely, but there are things that you lose with not being in the office with people on a regular basis. And not to mention, I'll just leave it at this, and you can give your feedback. Is we are social animals, and it
Right.
is incredible to be around people and not stuck in the same place that you live and work and sleep, and you're there all the time. So that's just my 2 cents. I think it's going to come back. I don't know to what level
Yeah.
at all, but I think it's going to come back.
Yeah, it's one of those hard things to quantify, but it's kind of what you see and hear on your own. I know Tuesdays are when I'm going to the office. It's the most heavily trafficked day. I can tell straight away when I leave my house in the morning. Mondays not so much. So there's definitely more. You look at parking lots. Obviously, we have a lot of buildings with surface parking here, but if you're driving around during the day doing anything, you can tell that there are more. They're full. Now there's some buildings where there's not many cars, but there's definitely that trend upward from what it was a year ago or 18 months ago.
Yeah, and
Yeah,
one thing that you guys put out that I thought was just fantastic about 2 or 3 weeks ago was the actual correlation between office utilization and hospitality, the occupancy at hospitality. And I thought that was really interesting. But when you think about it, a lot of these office buildings being in the central business district, right? I mean, that's going to drive a lot of the occupancy in the hospitality sector as well, and seeing that. So if we're seeing hospitality come back now, I don't think there's the reverse correlation, right? I mean,
yeah,
necessarily from a hospitality to the office sector, but I think that it might change. It's going to be hybrid, like everybody has talked about, but it does drive a lot of business around central business districts, and I get it. Like St. Louis and Kansas City, we're not Chicago, New York City, Atlanta, any of these things. So I think maybe it's going to be very very market specific as well, because we have these suburbs that are highly trafficked and people live in a lot more than maybe a New York City where that is really impactful.
sure. Yep, absolutely.
All right.
Yeah, so as I was mentioning, we've kind of seen the trough with absorption, and the way it's shaking out right now, we're kind of getting close to a plateau on available space. So this is the amount of direct available space and sublet space, and then the market's availability rate. So it's not going up. Obviously, you can see the drastic increase from 2020 to where we're at now, but it started to level off here over the past year or so, where we're seeing less sublet space coming on the market. So it's been a positive, while again availability rate is still very elevated relative to what it's been historically. We're at a point right now where we're maybe hopefully past potentially past the worst here of what's coming available. And as you can see, that the biggest shrinkage on this has been really with the available sublet space on the market.
Yeah.
That red kept getting bigger and bigger, really. Um, Over the last couple of years, and it's finally started to subside a little bit. But
Good.
some of that gets leased, some of that goes direct as the lease expires. But there's a multitude of reasons for that decreasing. And that kind of shows where we're at here. But we're down about 36% from the peak, which was in uh, early 23, late 22.
Wow.
So definitely something good for the market, but again, well above the 10-year average, as you can see there in the red, as to where where Kansas City has been historically with the amount of sublet space on the market.
Yeah, absolutely. Well, interested to hear your thoughts on the forecast here for sure.
Yeah, so this is obviously quarterly absorption and deliveries with our vacancy rate. We're still projecting a little bit of softness here going into 25. Again, as I mentioned, not as drastic as it was the last couple of years, but kind of a leveling. But as you can see, the markets has shifted drastically since pre 2020. Where your vacancy rates are sub 8%, even in the 7% range, and now you're up around 12%. So it's definitely been a big jump here, but again, as you can see, it's not as drastic as it has been over the last couple of years.
Well, I gotta imagine too. I mean, we don't have any data here on the starts for, for office buildings and things like that. But I mean, we can't forget about the most fundamental law of real estate, which is supply and demand. And
Correct.
so, I mean,
Yep.
that's got to have some impact here. I'm sure that going into 2020 and or 2021 potentially, there were already millions of square feet potentially that were under construction or getting ready to be delivered. And so, yes, that while this net absorption looks drastic here is probably because there were some net deliveries. Look at this. Net deliveries were pretty, substantially higher, pretty high in 2020. So I think that that's going to have a big impact. Because if we just fast forward here to 2022 and looking at 2024, look, we're pretty pretty low, in regards to
Yep.
the net deliveries. And looking at this for 2024 and 2025, looking to be that there is more deliveries coming online. I think that's a few trends that we can take from this is, I mean, these older office buildings that do not have amenities that people are looking for could be out of favor. And those are either going to be repurposed, knocked down, or they're going to stay vacant, or they're going to be redone, right? But the new product type that people are looking at, it looks like developers are starting to figure that out, and that's going to have a big impact on this office market as well.
Yeah, and that lead time is those buildings that were delivering in 2020 were probably getting conceptualized in 2015, potentially
Right.
that far back, 2016. By the time you're going through entitlements, design, approval, construction, it's not a short. You're not throwing up an office building in 9 months.
Right.
It takes some time.
Absolutely, because you're looking for tenants, you're looking for all of these different components. You want to have tenants typically. If you've got a good office area, you want to have a solid amount of that either already leased up or have in mind who those are going to be, in the property. Well, one of the most, I think, probably the biggest turnaround story that I have seen has been retail. And I'll say, like, a couple of years ago is when we really started to focus on adding retail to our actual portfolio. So we have 5 shopping centers here in Kansas City, and that was definitely before, I will say, before people were like, really, what do you do? Really jumped on this bandwagon. But shortly thereafter, I started to see the Wall Street Journal start to write about retail shopping centers being the new darling of the commercial real estate industry. And I have some buddies, a lot of buddies in the retail space across the country, going to ICSC and bringing back takeaways from those conferences. And man, it is a hot asset class, and I think for good reason. So I'm excited to dive into retail with you here.
Yeah. So as you can see here, this is the kind of the mirror of the office market, right? Since 2020,
Yeah,
we've had a huge uptick in demand. You know, as we're coming out of the pandemic, there was a huge surplus of spending power from borrow. Obviously the savings rate spiked as people were kind of at home not doing a whole lot, and then you had several stimulus packages come through, so there was a lot of money out there to spend, and you've had this huge shift in retail demand in general, right? Like, it was I, I think back to 21 and 22, trying to find bikes or couches, anything like that. It was 6 weeks to 6 months lead time on
yeah,
certain items. So there was a huge surge in spending, and obviously that leads to more retailers taking space and just spending power. But at the same time, stores like Target, Walmart, you have curbside pickup that all of a sudden evolved, so they're keeping their brick and mortars going. And then as spending, as everyone kind of restaurants particularly open back up, spending outside the home on food and beverage is at an all-time high still, and it continues to increase. So you had a huge surplus or a huge amount of demand for those types of quick service restaurants, and you've probably seen it, as well as anybody. There's been a huge pickup in that, and so obviously those users are building a lot of their stores because they've shifted their model from, your tradition. You think of a traditional McDonald's a couple of years ago. There's lots of seating, counter, all that. Now it's, we order on our phone, or you order ahead of time online somehow, and you go and pick up, Chipotle, whatever you want to call it. You have Hawaiian Brothers there in Kansas City that, has
Yeah.
a couple locations here in St. Louis now. And so, I know they shifted their model to be smaller for less in-seat dining, and that saves on the build out costs. You see Starbucks that don't have an interior cafe or anything. It's just strictly drive through. So, um, there's been a huge amount of development on that, and then obviously, you've had some closures with, likes of Bed Bath and Beyond and Bye Bye Baby, but those got filled pretty quickly. From what I've seen, what we've seen here, and again, you can probably speak to this in way more detail, but I think there's been a huge amount of value added for retail centers, as these tight conditions have pushed rents, for landlords to be able to push rents on that front.
I also want to point out net deliveries. Let's look back at 2017, right? I mean, the highest level here that we are showing. And then we fast forward to 2019, and we've actually got negative net deliveries here. And then we're coming up in 2020, got a little bit higher net deliveries, but then dropping off substantially. So again, supply and demand here. And I think about retail. People say retail is dying and things like that. I'm pretty sure that 3 out of every $4 still spent in the retail sector is in brick and sticks. You
Well,
know,
and we're kind of, I go back to when I started in this industry. Retail was heavily developed back pre 2008, before the great financial crisis. So there was a lot of excess development. In particular, a lot of that was in the path of growth, where
yeah,
home construction was going. Well, in 08 and 09, home construction fell off a cliff and slowed significantly. So a lot of those stores were in the path of growth, but the growth didn't happen. So it's taken some time here, and we've been under, the market's been underbuilt for years now. And as this spending has really increased the last couple of years, this is kind of this is what we're, what the result has been. Vacancy rates at all-time lows.
yeah, we have a lot of investors that are looking for retail shopping centers on a regular basis, and it's pretty hard if you own a neighborhood retail shopping center right now to sell for a couple different reasons. One being obviously the financing costs of what somebody can pay for that, but two is they've just performed so well. Like, where else are you going to go put your capital into? And so I think that's a it's been not so much on the trade side from a capital markets standpoint, from a transaction side, because if you're in a good spot and you've got a good, well located shopping center, you're at 3%, 4% vacancy, and the spots fill up extremely quickly. Like, you're hitting on all cylinders there. So I'd be curious to see what transaction trends and volumes look like in the coming years. But it's definitely a hot asset class. More people talking about shopping centers than I have ever had in the last 7 or 8 years.
Yeah. Yeah. So as we're getting into these, high absorption numbers, at the same time, obviously, that's the difference between move-ins and move-outs. So while we've had, you know, positive demand, but there's just less closures going on right now, less move-outs. So as you can see, this is trending down. Obviously, it peaked in around the second or third quarter in 2020, when a lot of
Sure.
folks had to close up shop. But this trend has been in filing down here, and the third quarter is one of the lowest levels we've had in the last couple of years. So just further proof that there's been a significant amount of strength in this sector.
It'd be really interesting to see what happens in the drugstore sector. That's obviously been a hot topic for a lot of people here recently.
Yeah, it is, and a lot. If you think about a lot of those, they are typically located at a very good intersection with decent access. So I would presume there's going to be some decent demand depending on what actually ends up closing. But what you end up doing with those is anyone's guess. But I think retail's been pretty nimble the last couple of years. You just look at what's I don't recall many doggy daycares as you see now, right? Or
Yeah,
pickleball concepts. There are other things out there that are obviously shifting the demand
yeah,
from
and
different
one of those
industries.
property types is starting to stand out, right? So I mean, this is really interesting on the smaller side.
Yeah. So, and as I was mentioning earlier, you had a lot of these quick service restaurants start building new locations, which are typically falling in that sub 5,000 square foot category. So this is by building size, availability rate by building size. But as you can see, the sub 5,000 square foot range here is really the lowest, again on record. It's sub 3% now, and obviously all these have been trending downward, but that's been the tightest, and it's I think part of the reason you're seeing some of these quick service operators just put up new stores, not only because their format fits, but there's not many options out there for them.
Yeah, absolutely.
And then, this is kind of the great divide. We talk about what is available and what's out there. About half of what's available right now, at least in Kansas City, is pre 1980 built buildings. So it's in that older stock. It may not have been updated, may just be a little bit dated, but a lot of the newer property types or newer product that's getting built is getting leased pretty quickly. As you can see, about half of what's available is over 40 years old at this point.
Yeah, and I think there's a number of reasons for this. Obviously, if people are moving to new areas or new areas are being built out, the properties are going to be newer in that area, but they're probably also a little bit different in the spaces and the formats and the look and the feel of those properties. And so we've seen a lot of investors and ourselves going in, buying those pre 1980 shopping centers and revitalizing them. And
Yeah,
I'll tell you this: if you do your investment in the facade, the painting, the parking lot, the lighting, the signage, those tenants will come and those businesses will come. So as long as everything else still checks the boxes, is vehicles per day, good location, good access, those types of things. But
sure.
that is this is what looks to me as a good opportunity for a value investor in the marketplace. So moving on to industrial, which obviously during COVID and a little bit afterwards was, I think, probably the hottest asset class in the United States, right?
Yeah, yeah. So industrial really, took off as things were, in 21 and 22. There was a significant amount of investment and development. Obviously we were in a period where interest rates were very low. Equity was a little bit easier to find than it is now. And you had a lot of spec development, but you had the likes of Amazon kind of leading the charge, leasing, a lot of space. And Kansas City is a pretty good sized industrial market. You've got the rail lines, obviously, highway access down to Dallas, north, or I'm sorry, south, and then obviously as far north as Minneapolis, and then you've got east-west access along 70. So there's decent connectivity there. Both St. Louis and Kansas City are within a day or two's drive of a large percentage of the U.S. population. So and obviously as development, you've got available space, especially as you go south down into Olathe. It was a good time for the industrial market to really expand significantly.
Absolutely. Well, let's take a look at some of the fundamentals here.
Yeah. So, Kansas City, obviously, like many other markets, saw a huge uptick in demand in 21 and 22, and that kind of dropped the market's vacancy rate down. But as you mentioned earlier, with supply and demand, as there's a significant amount of demand, supply starts to hit. So we've had the market's vacancy rate rise here over the last year and a half or so, but it's still trending just below the long term average. So it's not anything that is it's just basically normalizing at this point. You've got a vacancy rate in the mid fives, kind of similar to what it was pre 2020 at this point. But a lot of what was developed was a lot of large big box 500,000 square foot modern bulk distribution centers, primarily again south and along Olathe there along 35. But um, it's started to pick back up again. I think as 3PLs kind of pulled back a little bit over the last couple of years. They were kind of ahead of the game, or not ahead of the game, but kind of driving a lot of industrial demand, and that kind of fell off a little bit and slowed. So there's been a little bit of normalization there, but there's still demand out there. You're not seeing as many construction starts as you were, obviously, as rates were have gone up significantly from where they were. But you're still seeing some development. A lot of that is with a tenant in hand or a build to suit project. Kansas City has a pretty good size industrial pipeline right now. It's above the national average as far as percent of inventory under construction, but half of what's under construction is in is it Panasonic's building out in DeSoto, and I've got a chart that shows that here in a minute. But so that kind of future forecast ahead, there's not as much risk as maybe some other markets that are seeing a lot more uh, square footage under
Well,
construction right now.
Blaze, I'm looking at this and I'm seeing since 2020, close to 20 million square feet of industrial in deliveries, right? I mean, and vacancy rate still below pre-pandemic levels. So that's telling us something here, obviously. And I also think that developers caught on pretty quick with these, like you said, modern bulk facilities. They started to create some smaller footprints for people, and or started to decide, hey, that 500,000 square feet, maybe we go after five 100,000 square foot tenants or even smaller. And I think that is an ongoing trend as the onshoring continues to happen. People that might need 20,000, 50,000 square feet, I think developers are being nimble and trying to change to that demand in the marketplace.
Yeah, and I think you've also got some tenants that are trading up. Call it they're improving their their call it their building quality or clear height, as maybe they're modernizing their storage
Yeah,
facilities or whatever it might be. Um, Yeah, so we saw as a across the country, it was about a 13% increase in leasing activity. Kansas City jumped about 40% year over year, but that's coming off a kind of a multi-year low. So don't read like demand is increasing 40%. It's just coming up
yeah,
pretty strong. But I think in 23 and early part of 24, things were slowing down. But as of right now, there's been an uptick in demand here, or tenant demand. But as you can see, that 21 to 23 range, it was a pretty good, you know, strong market for leasing activity relative to pre 2020 levels.
yeah, absolutely. And I mean, this is kind of what we were just talking about, right? Availability is up the most in those larger properties. And I talk about this a lot because people reach out, hey, I need 20, 30,000 square feet of flex or something in the market. And I'm like, good luck finding it because it's just not there.
Yeah, and as you can see, that's your blue column there.
Yeah,
That's definitely the tightest part of the market right now. And as you're mentioning, it's something that has not been getting built much. It's mostly been on those larger properties. But as you see, it's still below 10% in all these categories here.
right.
So it's not. There's other parts of the Midwest that are a little bit have a little bit higher availability rates in these property types. So yeah, that sub 50,000 small bay, however you want to phrase it, is definitely been extremely tight. And then the months to lease those in our data has been very low relative to historic norms.
Yeah, most definitely. This was interesting when I saw this that KC has more supply coming to market than the rest of the country.
Yeah, but yeah, as I was saying, a lot of that is about half or so is in Panasonic's building out in DeSoto, which is a build to suit project
Right.
that's not going to be coming available for lease. So yeah, it's one of those things you always have to look at what's behind the numbers a little bit. But as the market is kind of slowed with construction starts, obviously when that facility delivers, that'll knock a huge chunk of this construction pipeline off. But we've got some time before that finishes construction. But yeah, as to your point about how much was delivered over the last couple of years, the square feet under construction, just a hair under 20 million at the peak back in 2022.
Yeah, and what I'm seeing here too is we have a pretty well a much smaller pipeline compared to the rest of the country if you remove out Panasonic and potentially even Meta and a few other of those big data centers could fall in that category, right?
Yeah, Metas does. It's about a million square feet.
Yeah.
Yeah, that falls under the
Okay.
call it the specialized property type there.
Got it. All right. So talking about rents in the industrial side in Kansas City, it's slowing in KC. Obviously, we talked about we've got some pipeline coming online, and it's all in those larger properties. So that's I would imagine that rents are going to have to come down for that space to get leased up. But I'm also
Yeah,
hearing a lot about that in California and some other markets as well.
yeah, and Casey's kind of going to, at least in our forecast right now, can be outpacing the rest of the country here in the yellow. As you can see, there it's not coming down as drastically as the rest of the country. Obviously, the Midwest is kind of known for not having the high highs, but also not the low lows.
Right.
Is a kind of a simple way to put it. So, Yeah, just it kind of holding the line here a little bit better than what we're seeing across the rest of the country. But again, it didn't peak as high as what we saw across the rest of the U.S. here.
Excellent. Yeah. All right. So looking at the industrial market forecasts, what stands out to you here, Blaze?
Well, yeah, obviously the big one is going to be when Panasonic's building delivers here. That kind of that huge spike in deliveries, sometime next year, and obviously that could shift based on when they finish construction with that. But it's just kind of stable conditions right now is the best way to put it. Nothing too drastic that we're forecasting right now. And we change these on a quarterly basis, but it's just kind of a steady eddy type of market right now, going forward. But as that supply pressure kind of recedes from what it was a couple of years ago, and if tenant demand were to really increase, we could see market conditions get a lot tighter here. And conversely, if something changed significantly where tenant demand fell, you know with less spec construction coming on the market, it wouldn't be as drastic as maybe you would see, in some other markets.
Yeah. Okay. Well, awesome. It's a couple takeaways for me in regards to office, industrial, and retail. Retail, if you've got the ability to purchase or build a new retail building in a good location, you're probably going to do pretty dang good. Number two, small bay, flex industrial type of spaces is in high demand, not just in Kansas City, but I would imagine across the country. So that'll be an interesting trend to watch to see if developers and or investors try to take larger spaces and devise them into smaller ones. And obviously the office sector is anybody's guess at this point, but I think that in regards to office, it does come back. We will continue to see the occupancy increase, and I think that it was showing that with the subletting that we showcased earlier. One asset class that we probably deal in the most here at Exchange, and a lot of people are favoring right now, because I think that one, people can understand it. Two, a lot of single family home folks that start their investment career in single family homes, kind of move up to the apartments, is multifamily. And wow, I have been astounded with Kansas City's year over year rent growth. I mean, I know it's not just CoStar's data, but Real Page's data and other places. Apartments.com, so not apartments, apartment list. I've seen so many different sources showing how well. And but on the flip side, from a supply standpoint, because that's what's really driving this, is how hard it is to maybe develop new housing in the Kansas City metro area. But man, Kansas City's apartment market seems to be doing just really well right
Yeah, the fundamentals are doing really well. And this is just kind of I just want I touched on this earlier with population growth, obviously, and this data is through 2023. But as you can see, if we index the Kansas City versus the rest of the country to 2011, the increase in population is definitely a positive for the market. So you've also got family formation and things like that that might lead to more apartment rentals. But as you've got more folks living there, there are a lot of them will need a place to live. So, just one, positive for the market. I want to say I did an article on this. Kansas City was in the top 20, I think, in population growth from like 2020 to 2023, if I remember
now.
correctly, comparing it to across the country. I'd have to go back and look at it, but this was a couple months ago I wrote it. So, um, definitely a positive for the market, especially on the multifamily front there.
Blaze, I get that question a lot, is why? And obviously I have my own prognostications on why, in regards to the population growth. But and then that conversation usually leads to the Kansas City Chiefs or Taylor Swift or something along those lines. I'm like, come on, guys, really? That's that's not really the economics of how that works. But I typically always go back to affordability, job growth, and standard of living. Those are kind of my three metrics that I'm always trying to track and take a look at. You pepper in there the idea that you can work somewhere and live somewhere and work somewhere else. That I think had a big impact on Kansas City's population growth, just in general, because it's a fun, cool place to live, but also I think it is a lot more affordable than some other places in the United States. But your thoughts on why we're outpacing the rest of the United States here?
I haven't taken a deep dive into it, but KC has had really decent population growth here now. It's not just post 2020.
Yeah,
If you look at this, it started, in really 2016.
sure.
So I think it's just been a part of the country that's had decent growth. It's a little bit, obviously, uh, you know, further west, you're a little bit closer to Denver, which has seen a lot of population growth. I know that's not a direct correlation, but there's all sorts of reasons for it. But job growth obviously helps. Affordability, I think, is on everyone's mind at this point in time, just given what's yeah, how the cost of a lot of things are up significantly. So um, yeah, there's certainly, I'm sure, a multitude of reasons. I haven't taken a dive into it, but you hit a lot of the big bullet points there that
Well,
I would
you heard
mention.
it here first, folks. The next article Blaze is going to be working on is why is Kansas City outpacing the United States in population growth? I can't wait to read it, man.
Yeah, it might take me a little bit of time to really might put my journalist hat on for that one.
Absolutely. Well, let's jump into some fundamentals. Before we get into our chart, I am extremely obsessed with knowing my numbers in my market. And right now, currently in Kansas City, on LoopNet or CoStar, we have around 50 properties listed, which is about 1,100 units. And here's a couple trends for you I thought were really interesting. The average unit per property around 23, right? So smaller properties right now. Average asking price per door is $94,000. Average marketed cap rate 7%. I just recently saw from I forget the source, but that multifamily cap rates are at a 10-year high across the country at 5.8%, which I thought was really interesting. On the properties that are listed, the average vacancy rate is 12%, which we're going to talk about here as well. But here was the unique part of that was the average vintage of those properties. Blaze, can you guess? 1947 out of the 50 properties that were listed. That was the average vintage. So what I'm
Wow.
seeing, and here was one last thing that I would say about this was the average days on the market were 64 days. So definitely taking a little bit longer than historical norms in regards to selling properties. But smaller properties, older properties, vacancy rates up around 12%. That is a unique trend that I haven't quite figured out exactly why that is the way that that is. But I just thought that I would. I'm not definitely not the director of market analytics, but it is my job to understand what's going on in the market. And I figured I'd throw some numbers and some trends out at you on stuff that's trying to be marketed for sale right now as well.
Yeah, that's interesting. That's I was gonna guess like 1970 for the
Yeah.
vintage. That was my hunch there. But yeah, I don't know what is off the top of my head. I'm not sure what would be driving that specifically. Whether it's long term holders that are looking to sell or what. I'm not quite sure.
Yeah, no, I think that just properties are getting older, and
Yeah.
1940s and 50s stuff is going to take a lot of capex to get back to be competitive in the marketplace, and you have to invest a lot into those properties to be able to keep up. And I think that's important because the mechanical, electrical, plumbing of all those buildings is now close to 90 years old, and that is a big hindrance for I think a lot of investors. So I think that's probably what's driving that. But look
Yeah.
like historical average vacancy rate was between 8 and 9%. That was sort of surprising to me on the multifamily side here in Kansas City.
Yeah, I mean, going back, this goes back to the year 2000. Obviously, as you can see, 21 and 22 demand was really strong until the back part of 22, as we're kind of going through a period of inflation was peaking. The Fed had just begun raising interest rates, and I think there was a lot of maybe a little bit uncertainty for folks, kind of getting out and wanting to maybe rent their own place. But we've seen a huge jump in demand here over the last 3 quarters, which compared to the first 3 quarters of 23, absorption was up, I think, about 75% or so
Yeah,
year over year. So pretty strong jump there. And that was um, not just Kansas City. That was it kind of a marker across a lot of other markets as well. And that kind of brought down our the market's vacancy rate back, below where we're at now, or below that long-term average, which it kind of peaked above here briefly in 24. Is obviously similar to what was going on with industrial. There was a lot of new development going on, and a lot of properties were delivering. So it's been good to see demand kind of keep up here over the last couple quarters, and brought that vacancy rate back down below its long-term average there.
Yeah, from a national standpoint, one big question that I had going into 2024 was, I think the last 10-year historical average we had been delivering around 350 to 400,000 apartments, nationally, and this year I believe it was double that. And so many, a lot of people were really worried that that amount of supply was going to really impact fundamentals in the apartment sector. What we found out was that was highly concentrated in New York City, in certain parts of Florida, Texas, and the Southeast, and Arizona. Okay, so I think that that's you have to really dive into, understand where those deliveries are actually happening. But it's good to see that absorption is up, and I've read quite a few articles here recently saying absorption's not just up; it's the best it's been in a long time, even with a lot of new supply coming online. So very interesting to kind of see in the trend there. And I think a lot of people's fears are kind of abated on that front.
Sure.
All right. So let's go into demand from the middle market of the market increasing in 2024.
Yeah. So the way we structure our ratings of buildings, you've got the 4 and 5 star, which most would think of a Class A, and then you've got 3 star, Class B, and then 1 and 2 star would be your Class C properties. So there's been a steady amount of demand amongst the 4 and 5 star set of
Yeah,
buildings, which is primarily what's getting built here over the last couple of years and even
sure.
before that. So most new properties that are being delivered are, to your point about the older properties, the new ones are highly amenitized. They have different amenity, whatever you want to call it, gyms, golf simulators, whatever it might be, co-working lounges. But as we've seen, consumer sentiment kind of come off its bottom, and when demand was reaching a low in 22 and early 23, that middle part of the market has really started to pick up again, and that's you know kind of created tighter conditions along those 3 star properties, which are not getting built as frequently, obviously, as the 4 and 5 star properties. Most of what you're seeing now are those larger, you know, 4 and 5 story properties that are several hundred units, again, that are also that are still highly amenitized. So, the last couple quarters, we've kind of punched above our weight here, and quarterly absorption is above its average since 2018, after kind of lacking here over the last couple of years before that.
Well, that's great. That drives us right into what's being developed here in Kansas City, right?
Yeah, yeah. So as you can see, as you mentioned, with the kind of the wave of construction coming on, this is the end of every year, going back about a little over 10 years now. So the pipeline's down, obviously, from what it was. It's a little over 6,000 units as when I pulled this data, but the construction starts are down, pretty heavily here. And again, you can talk to this just as well, but as borrowing costs were up, construction costs were up, everything was kind of increasing, your debt service costs and your building costs. It made it a lot harder for these deals to pencil on the development front. So we've seen a drop off in construction starts from where we were. So that supply side pressure is going to start to ease here in 25. And I don't have it in front of me, but I believe 25 is going to be probably a 6 or 8 year low in
Wow.
deliveries here. So that'll start to fall off a little bit, and probably give new landlords that have just opened their buildings a little bit more time to lease, and maybe a little bit less supply side pressure than they were seeing a couple of years ago.
Yeah. I continually get the question, Logan, who is all moving into these apartments? I see apartments being built everywhere. Well, you see them because you drive by it every single day. So
Right.
that's the one, right? Like you see the same building, that's big building, but it really only houses, 200 to maybe 300 people. And if you parlay that and correlate that with the population growth, it makes a lot of sense. Not only that, people transition from Class C properties to Class B properties, and maybe transition to Class A properties at some point, right? If they're not wanting to be a homeowner, and I think that's another trend from the generational differences of people wanting to own homes or can own a home versus wanting to be a renter and staying in that space. So those are some trends to be thinking about in regards to that. But this makes it really visible, and you can see that we are, from a construction start standpoint, at, like you mentioned, 2025 being a 6 to 8 year low, but our population growth outpacing the United States. Like, there's your answer. All right, so let's go to some base cases on vacancy, and then we'll go over to rent growth.
Yeah. So as you can see, we had a big uptick in call it 4 and 5 star vacancies really in mid 2020.
Yeah,
Kansas City was a little bit ahead of the trend, with development on multi. I wouldn't say ahead of the trend, but they had a pretty decent construction pipeline heading into 2020. So you had this peak in vacancies among 4 and 5 star properties that were just opening, and that's moderated a little bit. And obviously, this is a little more volatile because it gets impacted by buildings opening because you know 200 unit apartment building doesn't open fully occupied. It takes a little bit of time to lease up.
right.
But as you can see, that's been trending down, and then you've also got the 3 star mid level buildings that really saw an uptick in vacancies. Kind of going up about 200 basis points, a little over 200 basis points from 22 to kind of late 23, starting to recover a little bit as demand has come back. So, this is kind of a tighter dispersion than you'd see in some other markets, but
Yeah,
most of these property types, are kind of sub 8% here over the next couple of years, at least in our latest forecast.
yeah, that's great. Okay, fantastic. And then looking at our rent growth here in Kansas City as well.
Yeah, so like many other parts of the country, rent growth kind of peaked around 2022 when demand was at its highest and supply hadn't quite caught up yet. And as we've had a little bit of rising vacancies, we've had rent growth kind of slow from what it was. Now, you've had some markets go negative due to the fact that they're just vastly oversupplied, but
Sure.
they were also getting peak rent growth, maybe 15 to 20%. But as I was mentioning, you've got slowing deliveries coming here next year and into 26. So we're right now forecasting kind of an uptick in rent growth as there's a little bit less supply pressure, and as we're seeing demand kind of trending positively here over the last couple quarters.
Beautiful. Love that. And again, Kansas City continuing to top a lot of charts on the rent growth on the apartment market. This really breaks that down. Blaze, that was very insightful, my friend. That was a lot of information. Deep
Thank
dive,
you.
deep dive into the four main food groups. We talked about a lot. You definitely need to go follow Blaze here on LinkedIn. So here's the QR code to do that. And we have some questions to get through. You got a few minutes for some questions?
Sure. Yeah.
Okay, we got a few questions here, and the number one was planted by me, but that is, will September's job surge put rate cuts on hold? Because wow, what a roller coaster it has been in this sector and watching the Federal Reserve. But a lot of people thinking that because of what happened in the labor market, which we talked about, when we first started here, 254,000 jobs being added. That was, the strongest reading since March. So, will that impact what the Fed does in regards to rate cuts? I think that's what everybody wants to know, and that's what everybody's on their mind.
Yeah, I am not in the rate cut prediction business, but I do follow the CME group, which kind of has its own barometer for what they're
Sure.
calling for. And as of the data I was actually looking at earlier this week, they are projecting, nothing's ever certain, but it was, I think, 100% probability of rate cuts the next two meetings, which are November and December. So um, I don't know what that'll be. I don't know if it'll be 50 basis points or 25 basis points, but at least on what I'm seeing from them, that does not seem to be the case. That it's putting things on hold right now.
Yeah. Well, check this out. The Atlanta Fed's GDP now tracking model raised Q3's real GDP growth rate from 3.2 to 3.4, which I thought was really interesting. Real consumer spending was revised up from 3.3 to 3.6, and jobless claims also fell despite the worker strikes that we saw recently and the hurricanes. And manufacturing also held up, notwithstanding the Boeing layoffs and the bad weather. So really interesting stuff. You even think about retail sales. I mean, consumer spending was still strong again in September as the retail sales, rose 0.5% to another record high. So I mean, there's a lot of reasons I think that the Fed has to be thinking about. But also, guys, I mean, nobody's going to be able to get this correct 100% of the time and figure that all out. They're trying to do the best I think that they can in regards to where they're at. What I'm always thinking about is the current federal funds rate being around 4.75 to 5.25, and where inflation could be or is right now. It still seems like we're still in a pretty restrictive area, and not to mention, and I presented on this multiple times, that there is a lag between rate cuts and the impact that it has on the commercial real estate market and the economy at large. Yes, when you raise or cut the federal funds rate, it does impact credit cards and auto loans and things like that. But commercial real estate transactions take up to 6 months longer sometimes, and so that's it's not going to show up in this data, and I think that's really important to keep in mind. So while everybody's prognosticating on this, I think we just listen to what the Fed has said that they are going to do. Keep working, look at the fundamentals like we have talked about today in real estate. You're going to be okay. As John T. Chang, one of my favorite economists, says at Marcus and Millichap, you got to keep your eyes on the horizon, right? So,
Yeah.
all right, I got some other questions here. So, in regards to what you're expecting. So, okay, so this question is kind of all encompassing, but it's around the idea that I think this year in 2024, apartment. This is from you guys at CoStar. Apartment sales were at a 10-year low in regards to transaction volumes, right? You pair that with a lot of people tracking the amount of what they're calling dry powder or capital on the sidelines. With that federal funds rate potentially coming down, are we going to see an explosion of transactions or a flurry of activity for this quarter and going into 2025? I mean, what is your thoughts on that?
Well, I think, I believe some of this is also tied to the 10-year treasury,
Mm.
if especially if people are taking on, what's considered agency debt, which I believe has been one of the larger loan providers for multifamily transactions. So um I don't see how it can hurt transaction volume, right? It's just a matter of every deal's a little bit different, and every seller's in a different situation than that might be out there. But um, given that we reached such a significant low, we could be at the bottom here, and you're finally past the point of people expecting rate increases, and now it's at least leveled off and potentially seeing more rate cuts going forward. So
Yeah.
um, all that would dictate that there's a very good possibility where we could see an increase in sales here um, over the next 12 to 18 months.
Look, I think it's already headed in that direction. I think that cap rates and the multifamily side being at a 10-year high, I think people are going to start figuring that out, how to get deals done. I mean, there was a massive investor and owner psychology shift, when 2022 was going on, of buyers wanting tomorrow's prices and sellers wanting yesterday's prices. And if you didn't have to sell, you weren't going to. And I think that takes time. I mean, we're sitting here 2 years afterwards and waiting to see if that's happening. I think it is definitely headed in that direction. So I completely agree. And frankly, I'm not sure how it could get any worse from a transaction volume standpoint, right?
Right.
I'm sure it could, but okay, fantastic. So I think 2025 is going to be a good year. Fundamentals here are really strong. Blaze, anything else that we didn't touch on that you wanted to discuss today?
I don't think so. We covered a lot here.
This was definitely a deep dive, and we're getting a bunch of comments saying thank you guys so much, very insightful. So that was very good. Well, okay, well, Blaze, I got a few other slides to get through here, just some wrap up thing, but thank you so much. I very much appreciate not only you coming on today, but the work that CoStar is doing. I rely on it on a daily basis. I'm on that platform, so definitely go check out CoStar, go check out Blaze on LinkedIn, and we appreciate your time, Blaze. So thank you so much.
Thanks, Logan. Appreciate it.
Yeah, you bet, man. Thank you. We'll talk soon. All right. So let's go through what we've got going up here in the next couple weeks. So next week, we've got the Cash Flow Summit here in Kansas City. So please, if you haven't got your ticket already, make sure to come check out the Cash Flow Summit. I'll be speaking about Kansas City specifically and probably using a lot of the data that we talked about here today on this Market Pulse. Also, we just had last week our Contractors, Closers, and Connections event here in Kansas City, and we're gearing up for our end of the year holiday special on December 5th. So definitely come check us out here in Kansas City from 5 to 9 p.m. It's going to be a great event. Probably have 300 or 400 people show up to that event. And if you can't make that, make sure to check out the multifamily meetup groups. We've got one here in a couple weeks at String Hall, and then we'll start back up We'll let the holiday season get through. We'll start back up in January. So that's October 30th from 3 to 6 at Strang Hall. If you thought this was insightful, if you want more interest or insights in regards to what's going on in Kansas City and the market here in commercial real estate, this is how to get in touch with us. Find me on LinkedIn, find one of our team members on LinkedIn, go to our website, XChangeCRE.com, and definitely reach out. We are having so many conversations with property owners on what we're calling property and portfolio performance audits. So taking the BOV to the next level, really helping them understand hold, sale, refinance analysis, return on equity, and breaking that out in multiple scenarios. So please reach out to us. We'd love to speak with you. If you're a 1031 exchange buyer, we have right now around $20 million of off-market deals that we can get in front of you. So please give us a call, reach out to us, and we can evaluate those deals together. All right, in a couple weeks, we're going to have another special guest. I'm super excited about this. I have talked at lengths in regards to the 18.6-year real estate cycle and reading Phil Anderson's book and Akhil Patel's book. Well, Akhil Patel is coming on the Kansas City Market Pulse, and I'm so pumped to talk about where we are in today's current real estate market cycle, where we could be headed, and how to position yourself correctly. So be watching out for that announcement here in the next couple of weeks, and we will see you on October 30th, I believe. So in 2 weeks, we'll be here live once again. Thanks for tuning in. Reach out to us, XChangeCRE.com. Appreciate you guys being here, and appreciate Blaze coming in and dropping a ton of data-driven insights on the Kansas City commercial real estate market pulse.